However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind, okay? And then maintain at the rate where it has been for the past 2 decades or so, okay? So that's the history of our marginal tax rate so far, just so you know. Alrighty, so tax strategy number 1, reduce your gross income. Put your children on your payroll. Very quickly, I covered this about 4 weeks ago. This is a picture of my daughter who at this age, who was about 8, 9 years old, and she helped me around the office doing filing, entering data into the computer, so on and so forth. She's now 18 years old. And prior to COVID-19, she actually got a job, and I cannot remember what her job offer was, but it was not a minimum wage job for an 18-year-old. She got a really good offer. Unfortunately, after COVID-19, they kind of let her go. So she still kind of like to talk about that job that she got. This is my littlest son, and he is the model for one of my books, which I published. And basically, you know, I paid him to be my model, okay? At that time, when he was 3, 4 years old, he didn't know how to do office work, and so that's the job that I gave him. Okay. So now, if you have children and you run a business as a sole proprietor, okay, this is what you can do. You will, if your business, number one, if you find a business that makes money, you may want to hire your child, and let's say if you, in theory now, if you make that much money in your business, you could theoretically pay your child $18,000, okay? $18,000. And why would you want to hire your child? Because for the following reasons. Number one, it's your child, okay? So hopefully you trust them, you know them, and you trust them, and because you love them. You want to give them an opportunity to gain some working experience on their resume, all right? It also helps you reduce your gross income, your Schedule C income, if you're running your business as a sole proprietor, okay? And I'm going to get into the nitty-gritty detail of how that's possible, okay? Now, when your child earns $18,000 from you, this is what she can do. She would open a traditional IRA and contribute out of that $18,000, $6,000 into her traditional IRA, basically reducing her income from $18,000 down to $12,000, okay? And then she would take the other $6,000 and open a Roth IRA, okay? A Roth IRA. Over time, that Roth IRA, if you know how to invest it, over time, it will grow tax-free for the rest of her life, okay? Now, and then the remaining, for us, the remaining $6,000, she would then save that into a VUL or an IUL, which is basically a life insurance product that I'm not going to talk about. I mean, if you take the 4 financial workshops, you should know what these financial products are, okay? So that is how I would manage my family finance, you know, as far as paying my kids to work for me, okay? Again, it's great work experience for her essay. And, oh yeah, and if she has to apply for financial aid on her FAFSA, which is an application for all college-bound students to use to get financial aid, whether it's, you know, it's a loan or grant, you know, what have you. The money inside a VUL or an IUL is not being reported on the FAFSA because it's, for some reason, it's not considered asset, okay? So that's also another advantage as well. Alrighty, so now let's talk about tax audit tips. For those of you who have access to Third Rock from the Sun, the episode that I just shared with you, so after Dick found out that he got $375,000 of refund from the IRS, he actually got audited by the IRS. And so it's very funny. But so when you implement certain tax strategies, you want to make sure that you tax audit proof your tax return, okay? And I'm going to get into the details of this now, okay? So suppose the IRS sends you a note saying that it wants to audit your business hiring of your children, okay? In that case, let's say if you run a fast food restaurant business called Superstar Baguette, okay? So here are the basic facts. You claim a deduction for $24,000 in wages paid to your children, age 14 and 16, okay? So basically $12,000 you're paying to each of your them. And then during the year of audit, 2018, the standard deduction for a single taxpayer is $12,000. So basically on their tax return, they would report a $12,000 income, and then they have a standard deduction of $12,000. So their taxable income is zero. Make sense? Okay, so they pay zero income tax on that $12,000. But on your tax return, you get to deduct the $12,000 as salary to your employee, okay? So there are ways that you make mistakes, okay? When you implement this strategy, like Dick, he made a lot of mistakes, right? The first mistake he made was that he falsified his receipts. Number one. And then number two, he turned all his restaurant receipts into business-related meals, right? So that's after the fact. You don't want to be doing that. You know, you want to take advantage of the tax laws, but you have to do it before it happens, not after the fact, like the way Dick and his family did, okay? Because that's a no-no. So mistake number one, you explained to the court that you thought the law allowed $12,000 in wages so the children wouldn't have to file taxes. This is not true, okay? You must have a basis for the wage that you are paying your child, okay? For example, you have to be able to show the court that your child clocks in or clocks out, they fill in a timesheet. And you also want to make sure that you pay your child or children at a rate that you would otherwise pay an independent third party, okay? So in tax language, it's called arm's length. In other words, if your child is just doing cashiering work at your restaurant and you pay an independent third party to do the same kind of work, cashiering, for $15 an hour, but then you're paying your child $50, right? 50 an hour. That's not arm's length. Why are you paying an independent third party $15 an hour and you're paying your kids $50 an hour, right? It doesn't make sense. So you want to make sure that the wage that you're paying your child is comparable to what the market demands, okay? It's extremely important. Mistake number two that people make, that I see. You testify to the court that your children help you with daily tasks by cleaning the toilet, counting the cash, taking orders from customers, sorting and restocking various products on the shelves. You also testify that your children work about 10 hours a week. But then you also admit during trial that you do not know for sure how much your children work weekly or how many hours your children work weekly, and you don't keep any records of their hours, right? A legit business would never do that, okay? So So think about how a business is run, and you do that, you do the same thing, okay? If you hire an independent third party to come in and do this, cleaning the toilet, counting the cash, taking orders, sorting and restocking, do you want them to be accountable? And if the answer is yes, you want your child to be accountable for that as well. They have to act like a real employee, okay? And this is not just like on papers only, okay? If you're doing this just on papers, the chance of you losing this case is gonna be very, very high, okay? And that's the difference between good tax planning and bad tax planning, okay? But you can do it, you know how to do it the correct way. So for this mistake, here is the solution. You wanna make sure that every week you have your timesheet filled out by your child or children, and you have to tell them, they have to write down the time, the hours that they worked, and the tasks that they performed. Basically, they have to keep a timesheet, okay? Mistake number three that I see. You also show the court all the canceled checks showing $12,000 being paid to each child, okay? You wanna make sure that you use a W-2 payroll service, because this is a legit business that you're running. Just so you know, wages paid by the parents to children employees who are under 18 are exempt from payroll taxes. So no FICA, no Social Security taxes at all. They're exempt, okay? And if they're under 21 years old, they're also exempt from unemployment taxes as well, FUTA tax. Make sure that you examine the first paycheck when you use an outside of W-2 payroll service to ensure that the payroll service properly exempts the children from payroll tax. I used to have the payroll service work for me, and they even though I told them that, okay, my children are the employees, they didn't know how to deal with this. So when they cut the first payroll check run, they totally did it wrong, okay? So they withheld taxes on my children's payroll, FICA tax and all that. And so I had to go back to them and tell them to fix all that, because inadvertently, if you don't know this law, right, you could be overpaying your FICA taxes on your children's payroll. So just one thing that you need to be mindful about when you implement this tax strategy. And mistake number four that I see is that when you pay your children, you actually endorse the checks that you write to your children, which is a no-no, because you have to treat them like an employee, okay? So they have to be the one endorsing the checks. And you don't have any control over that. And that's the reason why it's very important for them to attend the financial classes, for them to understand compounding interest, how to do a budget, right? And all of that. Because they will have a tendency to take the money that they got from you and go spend. And if that's not your intention, then, you know, try to help them out, okay? So in this case, though, if you endorse the same check, you wrote the check and you endorsed it at the same time, and you would then deposit that check into the same checking account. In other words, you don't have a separate account for your kids' money. That's a no-no as well. You have to set up a separate checking account to deposit their payroll check, and their checking account has to be under their name. Make sense? Okay? So this is the right way to do it. So I was talking about that. The solution 4, have your children open their own checking account or Roth IRA account. Because children are minors, you will need to establish a custodial account. Number 3, open an IUL or VUL for them, like us, right? That's what I do for my children. All my children have, each of them have this. All right, so another question that I've been asked is whether or not the child can open a Roth IRA. And the answer is yes, as long as she has earned income. So if you have a 7-year-old daughter and your tax bracket is 39%, you're in a very higher tax bracket. And if you pay her $5,000 a year to work for you, okay, she can put the entire $5,000 into a Roth for the next 10 years or so until she's 17, okay? Now, on your tax return, you write a check for $5,000 payable to your child's name, okay? And then you deduct $5,000 from your gross income, okay? And because you are in a 39% tax bracket, the tax savings that you have on this tax planning strategy is about $2,000, right? $1,950, okay? And then your daughter collects $5,000. She pays no income tax, nor payroll tax, because $5,000 is less than the personal exemption of $12,000. Does that make sense to everybody? Okay, so as a family unit, you save $2,000 in tax liability. Make sense to everybody? All right, so why does saving $500 a year matter, you would ask? Well, because of the value of compound interest. And so I ran, and you can go to the company's website here, everybody, www.innochamp.com. And there are many different options that you could choose. But if you go directly to investment strategies, you're going to see a lot of calculators. And you can just put in, okay, if I save $500 a year in taxes, okay, that's my annual saving, okay? And if I take that $500 and invest in something that would earn me an average, remember I said average, I didn't say real rate of return, average 7%, okay, for the next 30 years, how much would I get after 30 years, okay? So here's a graph of, it's a lot of money. It's like $54,000 something, okay? If it's in a Roth IRA, I mean, that's a lot of growth for the next 30 years or so, right? Okay. So, yeah, $46,000 during the next 30 years or so. If every year you save $500 and you keep doing that, and you teach your daughter or your son to be disciplined about their money, and get them to take the 4 financial classes and, you know, learn alongside with them. They know how to invest. Well, that $500, you know, every single year could turn out to be this much money. And especially if it's sitting inside a Roth, I mean, we're looking at a lot of money down the road, okay, in the next 30 years, 60 years or so. All right. Tax strategy number 2. Oops, it's a typo. It's not number 3, number 2. Again, in the clip, we saw that they claim home office deduction, right? Dick and his family. So this is quite important because a lot of people out there have this misconception about home office. And the most common misconception is, oh, I don't want to take it because it's going to raise a red flag. Or my prior CPA has told me not to take it because it's going to raise a red flag. Well, it's not going to raise a red flag if, number 1, is a legit home office, and number 2, you meet all the requirements for a home office deduction. Make sense? Because the tax laws are written to allow you to take home office deduction. The only reason why it raises a red flag is because you don't do it right. That's why, right? Like Dick, I mean, how can you have a refund of $370,000 in taxes for claiming a home office? You know, that's just ridiculous, right? Okay, and that's why he got audited. Okay, so number 1, you want to make sure that your home is used exclusively for the business for which you are seeking the deduction. It's very important. It has to be used exclusively. In other words, you cannot mix personal and business in one space. And we're going to talk about how big that space has to be, okay? If the home is used regularly for business, at least for me, when when I advise my client, they have to use it for at least 10 hours a week, okay? And if you actually run a legit business, even if it's a part-time business, you do it on the side, 20 hours a week, to meet that 10 hours a week is not that hard, okay? You may perform administrative or management activities of your trade or business at your home office. HO stands for home office, okay? Now, the tax laws allow you to do admin and management activity. So let's say if you are a doctor, you have a doctor's office at a shopping center, okay? But you maintain a home office at home. Can you take a home office deduction? And the answer is yes. A lot of doctors I talk to, they say, well, my prior accountant didn't allow me to take a home office because I already have an office at the mall. Well, you just lose money not claiming it. Laws allow you to do it if you know how to do it, okay? Because the laws specifically tell you that you may maintain a home office doing just the admin or management activity. You don't have to be the one doing the client's piece, you know, at home or seeing the clients at home in order for your home office to be classified as a home office for tax purposes. I hope that clarifies a lot of the misunderstanding and the misconception out there for many of you, okay? And you have no other fixed location where you conduct substantial admin or management activities of your trade or business, okay? So let's say if you could argue that you perform all of your admin related functions or management functions at your home office, then you can claim your home office deduction. Make sense, everybody? All right. So what are the admin and management activities the tax codes are talking about? Number one, you do your customer billing or client billing at this home office deduction, home office location. Number two, your home office is where you keep your books and records, okay? You order supplies from this home office. You set up or schedule appointments from your home office. You also write reports from your home office. Now, I know a lot of doctors out there also teach, okay? Professors, right? They teach at a university. They also maintain an office, you know, like psychologists, for example, okay? They run a small practice, and then they teach at a university. They come to me, they ask, well, can I take a home office deduction? Well, they can if they do the following functions at their home office. Let's say they have to write report to give to their client, okay? That would be considered a substantial admin or management activity being performed at this home office location. I always tell my clients to avoid performing a lot of admin and management activities outside of the home office, okay? So, like I said, it depends on your personal situation, and that's the reason why I have a disclaimer at the very beginning of the webinar, because your personal situation might not fit into the laws, in which case you're gonna need to do some planning or change your routine or change the way that you operate your business so that it will fit into the tax law that would allow you to take home office deduction, okay? All right, so how to claim a big home office tax deduction? The good news is setting up your small office to meet the IRS's requirement is fairly easy and inexpensive. The bad news is if you want to comply, you will want to comply carefully with the IRS rules and guidelines, okay? So, an example, and I'm gonna be talking about real court cases now, okay? Just to show you some precedents so you know what's going on out there, okay? So in this court case, Albert Mills, he successfully defended his home office deduction in court, even though his home office is inside a tiny little apartment that has only 422 square feet. So think about that. When you live in a tiny apartment that has only 422 square feet, I mean, how big can your home office is? Okay, but he's successful in defending his home office deduction. You must also find an area in your home that you can designate as a business area for your home office. Again, the key word here is exclusively, right? So you have to use the space exclusively for your business, okay? So let's say if you have a table, a dining table, and your dining table is used to have dinner, lunch, and then you also use the same table for your office. Is that allowed? The answer is no, that is not allowed. Okay, why? Because that table is not used exclusively for your business. So you have to find a different table. Okay, and you cannot use the same table and claim that space where the table occupies is your home office. So that's a no-no. Can you distinguish the facts here, ladies and gentlemen? Okay, you do not have to mark the area with a permanent partition. In other words, you don't have to have a cube in order for you to claim that space as your home office. The laws allow you to have a de minimis personal use, okay? So you can set up your office in an area that you must walk through for personal reason. And actually there's a court case that talks about this. In this huge case, okay, home office is actually a walk-through closet, okay? So, but the walk-through closet is behind, is in front of the bathroom, okay? So his space only has one bathroom. So in order for him to get to the bathroom, he has to get a walk through this walk-through closet, which is being used as his home office. And so even though he uses the bathroom for personal reasons, okay, the court still allows him to deduct his walk-through closet as his home office, even though he does not use the walk-through closet exclusively for his business. Why? Because when he needs to go to the bathroom, he has to use the closet. He has to walk through the closet to get to the bathroom. So the court thinks that is a de minimis personal use. De minimis means little, small, okay? That's what it means. De minimis, that's what it means, little, small, you know, negligible. All right, so now, for those of you who do not have a very large home to do a home office, this is how you will create a 1-foot home office, okay? You can buy a storage cabinet or a shelf that extends all the way to the floor. And then you use this cabinet to store business items such as files or business supplies. When you work at home, you pull that table or the storage cabinet next to the cabinet, okay? And you do your work, and when you're done, you remove the table if you need extra space. So go back to the example I had earlier where you have a dining table and you've been using your dining table, and you call that dining table space as your home office. So stop doing that, okay? What you want to do is you want to follow this. You have a cabinet, and this cabinet extends all the way to the floor, okay? And then when you have to do your work, you're going to use a different table, and you're going to pull that table next to your cabinet. And after you're done working, you would remove the table, okay, if you need some extra space. Now, you can engage in personal activities everywhere except the cabinet space. Is that clear to everybody? Okay. And when you file your tax return, you only claim the space for the cabinet. Make sense? So you're asking me, okay, well, the cabinet is small. It's like, I don't know, maybe 2 feet by 3, like 6 feet, right? Okay, how much in taxes can I save if I have 6 feet of space for my home office, right? That's not the point. The point I want to make is that if your business happens to require you to drive, okay, you can actually treat your mileage, your commuting mileage, as business mileage the minute you back out of your garage door, because now you go from your office space to wherever you need to go to meet a client or to perform your service. Does that make sense? If you do not have a home office, when you back out of your garage and you drive to a location, that is called commuting. It's not business. I hope you understand and you can distinguish between the two, okay? If you didn't have a home office, when you drive out of your garage and you drive somewhere, that is considered commuting, and that's not a tax write-off.